Hello everyone and welcome to the Kerrigan Advisors Market Update. Today I'm joined by Ryan Kerrigan, Managing Director for Kerrigan Advisors. Thanks so much for joining us today, Ryan.
Thank you, Bridget. Good to be with you.
So what's going on with the Kerrigan Index for June?
Well, after a really wild ride, the Kerrigan Index settled down a little bit in June. The index was up 5% for the month, and year to date, that means we're down 8%. But as your listeners will recall, that represents an incredible rise in January and February, followed by an absolute collapse in March, down close to 50%. So now we're starting to regain most of that lost ground from March.
How does that compare to the S&P?
Well, the S&P is faring a little better than the Kerrigan Index. So year to date, the S&P is down only 4%.
What do you attribute this to?
Well, it's a good question, as auto retail has really come through this period quite well. So why are the markets holding back auto retail stocks a bit relative to the broader index? And I suspect it's the perceived economic sensitivity, given that cars are such a large purchase. And also our public stocks are on the small side. Our market caps run in a couple $1 billion per company, so there's often a discount for smaller companies.
What else do you see in today's market?
Well, we have the benefit of having countless conversations with dealers across the country, and dealers' businesses are coming back really strong and really quickly. Many stores are posting record May and June profits with really strong gross margins in the new car business. And the strong demand for vehicles, interestingly, is actually causing a shortage in inventory for many dealers. Some brands like Hyundai and Kia are better positioned to keep the cars flowing, but there's some domestic dealers that are really running out of trucks to sell this summer. Toyota and GM seem to be the most impacted as it relates to near-term inventory issues.
So with the shortage in new vehicle inventory, how can dealers pivot to keep up with demand and profitability?
Well, dealers are doubling down on used cars and taking advantage of a healthy supply of off-lease vehicles coming into the market. And there are many dealers that have flipped their business models, now selling 2-to-1 used to new, where before they were selling more new cars than used. And a high-volume Toyota dealer told me recently that now they're making their money on gross, not volume. Everything at MSRP, which is something that we've not seen in years. And of course, you need to focus on the fixed operations. It's always easiest to make up losses in gross margin in fixed ops, given the very high gross margins there.
With all of this volatility in automotive right now, is anything changing with blue sky valuations?
Well, yes, that's the big question. And interestingly, the answer is we've not seen a big change in blue sky values. While the pandemic was an unforeseen nightmare for operators, it was a great reminder of how flexible the auto retail model is. Dealerships got through this better than anticipated and bounced back really strong as early as May. And we got calls throughout from buyers who were looking to do acquisitions.
But profits took a hit.
Yes, they did. March earnings were down on average 65% over February, and most dealerships posted a small loss in April. But as we stand here in June, profits have been restored, and many groups are tracking in line with 2019 profits, if not even ahead of 2019.
So I read that Kerrigan Advisors is characterizing COVID-19 as a one-time event.
Yes, we are. As it relates to valuation, we don't believe you can learn a lot from recent months about where the business is going. Some dealers had to shutter their showrooms in early March. Others didn't shut down at all. Some dealers kept on all staff. Others did aggressive layoffs. Some dealers took PPP. Others did not. This is just a crazy period, and it's a one-off experience, and we're going to move on from here. So we don't plan to spend a lot of time trying to analyze and trying to figure out all the accounting to make sense of the recent chaos. We think of it as a one-time event.
That all makes sense. So what are buyers looking at when it comes to dealerships' 2020 performance?
Well, buyers are trying to gauge whether a dealership is trending back to 2018, 2019 performance levels. So for example, Lithia is underwriting deals today to make sure that they're going to get back to 90 to 95% of pre-COVID levels in order to fully pay out on the deals that they're structuring right now. Now, as it relates to valuation, we're seeing two different thought processes starting to play out. For dealerships that have strong, stable performance in 2017, 18, and 19, and they seem to be trending back to those levels, we're seeing pricing based on 2019 financials. Now, for dealerships that did not have that steady stream of earnings in the prior years, and there's real questions about where they're going in the future, whether positive or negative, we're seeing a lot more work being done on pro forma projections and basing valuations based on those pro formas.
So there's a real art to current valuations today.
Yes, there certainly is, and that's what keeps our line of work interesting at all times.
What about dealership real estate valuations?
Well, there could be some softness here across the board, and that could impact our industry as well. So retail store closures, not auto, spiked 35% in 2019, and that was pre-COVID. Now, overall retail closures are expected to accelerate in 2020. So we're going to have a lot more retail vacancy, and certainly some classes of retail real estate are going to really start to fall. According to Green Street Partners, commercial real estate prices are projected to decline 10% from last year through April of this year. And so while auto retail rents remain strong, we suspect that lower comps along big retail corridors may start to filter into auto retail appraisals.
So likely a dip in real estate valuations.
Yes, although I should say that interest rates are incredibly low, falling yet again, and so that's going to mitigate any downward pressure on real estate prices. But yes, on balance, we do see some downward pressure.
As a result of the coronavirus, have you seen more sellers or buyers coming to market?
You know, we've honestly seen both. As I think I mentioned, we got calls from buyers throughout. In March, there were some very well-funded dealer groups who were saying, hey, if there's distress, please call me. We're interested. But by late April, early May, that had shifted to lots of groups saying that, hey, we're feeling much more optimistic. So this is our chance to grow. So please let us know about acquisition opportunities. And then by June, we got back to work on deals that have been paused by the shutdown. And we got calls from some older dealers that said, you know what, I think it's time. I've managed this. It's been a great run, but I think it's time to talk about a sale in 2020.
So would that indicate increased activity in the upcoming months?
Yeah, now these transactions take some time, but we're definitely going to see some announcements later in the year, and there's going to be some really uniquely good assets on the market in the course of 2020.
Are buyers changing the business model as they buy stores?
Yes, more so today than before. So for years, we have seen buyers de-emphasize print and radio advertising, shifting to less incentive-based sales comps, introducing product specialists, going to flats, things like that. But now we're seeing even more of that. We're seeing a faster push to all things digital, and this includes a move towards full digital transactions. So we are seeing more operational change after a buy-sell.
Thanks so much, Ryan. We always enjoy our conversations about the buy-sell market and the valuations. Thanks so much for coming on the show.
Of course, my pleasure.
Thank you for watching the official news source of the retail automotive industry. This has been a JBF Business Media production.